go.
Good evening and welcome to this very special edition of Let's Talk About, coming to you live from the Trinity United Church here in Legon. Today happens to be the second edition of Let's Talk About for the year, but the very first when we are talking about the talk editions. And thank you so much for joining us last week for our prayer time. And in recent time, a lot has happened within the financial sector, coming from the latter part of last year into the beginning of this new year. And as scripture tells us, behold, I send you out as sheep to wolves. You should be wise as the serpent and as harmless as the dove. And so we need not to be oblivious of the things that are happening within our country and around us in this world. And it's for this reason that on Let's Talk About, we seek to not only inform you, but also equip you with the response skills when some of these challenges become a thing that we have to deal with. And so today, we are talking about what is in a haircut. What is in a haircut? Domestic debt exchange program, haircuts, mark to market, all of those terms and jargons, what do they mean? Today we are going to be breaking all of that down, and we are very fortunate to be joined by someone who works within the space. Our guest is an investment professional and a certified coach, and she's going to be talking to us about all of this detail. I want you to help me wherever you find yourself. Welcome our guest, Madam Miriam Maku Emisa. Miriam, you're welcome to Let's Talk About.
Thank you very much, Benji.
Great. My name is Benjamin Ofeado, and I'm going to be your host for today's edition. And let's just get straight into the conversation. But before that, as we go on with the conversation, I'm sure there will be things that will be coming up that you would want some clarity on. Please feel free to share your questions, your comments, and your own contributions on the respective links that you are watching. We are live on Trinity United Church page on both YouTube and Facebook. You can drop your comments in there. We'll be very happy to read them and provide you with responses. So, Miriam, let's start off with this domestic debt exchange program. What is it?
Thank you for the question. It's very good that as Christians we get ourselves updated, like you said. So I was telling you earlier that as an investment professional, I have tried to stay away from discussing this topic in public, because if you are not careful, you'll be tagged. But from what she said, it just re-echoes that as Christians, we need to be abreast with what is happening. So what is the domestic debt exchange program?
Exactly.
In very simple terms, I earn a salary. And so from time to time, I get loans. But there's a point where at a time I have to pay off, but I'm not very liquid because maybe I've put my money into some trade or business. So in the short term, I probably have to ask someone to bail me out. This is not the first time we're going to IMF. In fact, this is the 17th time. And so what has happened that today going to IMF has necessitated a program like a debt exchange program. And it's because our government is unable to pay the debt it owes with the current arrangement or agreement it has with us. So what he's saying, the government is coming back to us and asking for is that, okay, at this point I can't pay. I want to give you different terms to the contract or the agreement we have that is more favorable to me to be able to pay you. And if you take me to court and I owe you, and I said I'll pay by 2 months' time, and I can't pay at that 2 months, it's okay for me to give you a payment plan.
Yeah.
So it's like the government is coming with a new payment plan and saying exchange it for the one you already have.
Okay.
So that is the debt exchange program. And the reason why it's a domestic debt exchange program is the domestic is for the locals.
Okay.
So what it owes the local, because the government owes both external creditors and then internal or the local one. So this applies to the local creditors, which means that eventually we will get to the external ones.
Yeah.
Yes. So in simple terms, that is what the debt exchange program is
So
about.
the government owes us or owes creditors, and those creditors will be investors in instruments that the government has issued.
Exactly.
And the government is saying, I'm at a place where I won't be able to honor those obligations per our initial arrangement. And that I want us to use different terms.
Yes.
That's basically what we are doing. Because they are not able to pay per the original terms.
No.
But how did we get to this point? What brought us here? What necessitated this kind of debt exchange program?
Okay, so just to give a bit of history to it, like I mentioned, this is the 16th or 17th time we're going to IMF.
Yeah.
We've all heard IMF before. In fact, it was one of the promises that we were sure we wean ourselves off.
The IMF.
But here we are again.
Yeah.
And typically when countries go to IMF, it's because one, they are illiquid, or two, they are insolvent, among other reasons.
What is...
So illiquid, like trying to explain it with my salary, for instance, is that I have loan obligations, but I don't have the cash now to meet those obligations. So I go and borrow money and then pay back.
You have a salary?
Yes.
That you use to typically pay
off my loans.
But your salary is not yet in?
It's not yet in.
Okay.
And my loan repayments are due.
Okay.
So I come to you
for another loan
to pay off, so that when my salary comes, I can pay it off. So that is illiquid. I don't have cash now.
Okay.
Then the second part is, even when my salary comes, it will not be sufficient to pay you back.
Oh.
So at that point, I'm insolvent.
Okay. So let's take it this way. In a month, you typically pay school fees, your rent, electricity. All of it comes to 100 cedis. You have a salary of 150 cedis, but your salary has not yet been paid. And so you go to borrow 100 cedis from someone to use that to meet your school fees, rent, electricity bill.
Yeah.
And then when your 150 comes, you pay back. That's you being illiquid, and so you went to borrow.
Yes.
Okay, now let's look at the insolvent bit.
So now that 150, amongst the expenditures you mentioned, the school fees, the electricity, etc., you have come to me to borrow money from me as well.
Yeah.
Which is like another 100 Ghana cedis.
So now it brings my obligations to 200.
Exactly.
But I earn only 150.
Exactly.
Okay. So even if my 150 comes, it won't be able to satisfy the 200?
No.
So I'm insolvent?
At all.
I see.
So now I have to go to my creditor, who I owe the 100, and tell them that, okay, I'm not able to pay you that 100. So let's change the terms of payment.
Okay.
Maybe by that time, I'll be able to generate enough, or I'll get a salary increment that will cover it. So I give you a different terms of payment. Or I say that let's break it down into 50-50, and then every other month I'll pay it to clear it off. So in turn, I should have paid you next month, but now I'm spreading it. So I'm exchanging this old contract for a new contract. So we are at that point. And so the other 16 times we went to IMF, we were illiquid.
But this time around,
this time we are insolvent.
I see. So we don't have enough to meet our obligations.
No, we don't.
And that's the problem we find
Yes.
ourselves in. So this domestic debt exchange program, I mean, what does it entail? What are the various details of it, as has been announced by the government?
Okay, so just before we get there,
Yeah.
other factors also determined how we got here.
Okay.
When you become insolvent again, there are two ways that you can look at getting yourself out.
Yeah.
It's either you increase your salary, like I mentioned, or you cut down
Your expenses.
your expenses. Maybe you can tell your child to stay home for 1 term,
Okay.
so that you don't have to pay school
Or you can
fees.
change their school
Or you can,
from a
exactly.
private school to a public school.
Yes, you can do that. So that's the two options that our government had. And if you would remember, last year, they tried pushing in the e-levy.
Yes.
So that was a means of generating more income.
That's increasing their salary.
Yes.
The government salary. Okay.
So this time, they were trying to get more money by increasing the taxes that we pay.
Okay.
Unfortunately, we were tired, and so we pushed back. We pushed back until a time that even though they still implemented it, the outcome or what they anticipated to get
Was not
out
enough.
of that was not enough. Then another way we could also generate income or get more money was being able to go to the external market to borrow.
Okay.
Now, that has also been cut off, given that a year prior to that, they had been mentioning that your debt stock against GDP is going too high. You need to watch it. So by the time we entered into 2022, the external investors had decided that we won't lend to you anymore. And so we couldn't even go to the external market to borrow.
So they were saying that our debt relative to our GDP was growing to a level that they called unsustainable.
Exactly.
So we heard that we're downgraded to junk. Our status was reduced from maybe even B+ to C to, and it came further. What did that mean?
All those are indicators for the external investors to see whether you'll be able to pay back, your ability to pay back.
Yeah.
So these are all indicators. And so when they see these things, then they begin to pull away from investing more money into the country or to fund whatever expenditure that you have.
So these ratings were saying that we were not in a position to pay.
Yes.
So our ability to pay was reduced
Yes.
per these ratings.
Yes.
And that is why the external creditors were saying they cannot lend to us.
Exactly.
Okay.
So we had the e-levy, but it didn't work because what we anticipated, we got just about 1/10 of that. The revenue we were expected to raise.
Yeah.
And if that had gone well, it would have indicated again to the foreign investors that, okay, they have the ability to generate income, and on the back of that, they can bring in more money. Unfortunately, that didn't work well for us. And so these things again led to us going and saying that, okay, at this point, we need to do something to bring the debt down.
Okay.
And so that is another thing. Other external factors that we all know about is the COVID that we needed to recover from, and then the Ukraine-Russian war.
Okay.
Those external factors we didn't have much control over, but it affected us drastically. And this had to do with when you talk about the depreciation of our CD.
Okay.
So it just made our interest payments more, because now you pay it in dollars.
Yes.
Okay. So if your CD is depreciating, you needed more CDs to pay off those loans. So all these factors went into us getting to this point where now we have to have the domestic debt.
So let me see if I understand well the issue that you raised about the depreciation of the cedi. So for instance, we may have taken a loan of 100 cedis or $100 at a time when the cedi to the dollar was 12 cedis. What that means is when we took the money, if we had to repay it at that same time, we would have paid 1,200 cedis.
Assuming there's no interest.
No interest. But at the time we had to pay, because the cedi had depreciated against the dollar, we now needed about 15 cedis to get $1. What that meant was when we had to pay 1,500 cedis to be able to clear our debts. And that's how the depreciation affected the value we had to find to pay our debts.
Exactly.
I see.
Got our situation worse.
Yeah.
As someone say, worse and worse.
It got worse and worse. Okay.
Yeah.
So, if you are just joining, we are talking about what is in a haircut. And we've started talking about the domestic debt exchange program, what it is, how we got here, and then the various elements that go into this particular domestic debt exchange program. And we've been having Madam Miriam Maku Amisa explaining this to us. And for the benefit of our listeners who are more proficient with Chi, Miriam, if you could just give a quick summary so far the things we've spoken about in Chi.
Okay. Indeed. Debt exchange program na ye kan wasem no. I say mede oka na wose mitiaka. Na kana mede o no se me hwe mahoden e na mede je sa aka no.
Yeah.
Ti emfa ne say emre kakra buy no, it's like mako ye nema na mako jije nema boso. Ti mitia we nti edru se metia oka no me hwe ye na mahoden so. Nti me obra panyin bi wo hwa ye frɛ no IMF. Normally meko ne ho akwaje bosia na me de tia oka me salary ne ba na me de amano. Aha. Nti me ka say IMF no big brother ye ko ne ho kwaje bosia no yakɔ ne ho da yetako. This is the 17th time I hear call. But they are different from this and say all the other times na ye call no. Na ye will be a to me jinaso e kobo bosiano. But sisia no ya bo bosian wo baby ama abo yeso. Inti de jinaso cry ye de bekwa kobo bosiano. And so inti afe no na meche mu nso che say anka na enema other things wo ho anka betumi aye ma anka debt exchange program mi emba eno ni 11 na ye de buy no sana say your salary na make in that sense your salary ni be increase and our revenue ni be increase but 11 no say na ye nya ye hu ye no na Ghana for abre they be our taxes into there was a pushback ma de na ye hwese ye benye free mu no ye nya free mu ebiom no investors omo amanone ene nsa na kan outside omo disikaba ebe ye investment wo ha but again omo hwe baby a your debt ye
yenkan
edru no omo hwe a ye ntumi ntia nti omo so omo say ene omo nya biom nti ye ntumi nkoho enkoje sika emba de ka se ye beye wo ha so which is 11 no amfa sika no ambase na ne expecting no nti the ability to raise more income no na eni hosa hode ne yentumi anye ti afi de baby edu no e wo se ye ko omo boy ye bosia ne ho ne ye ko sere omo se unim me share wo say by next month meet ya oka but the edu no mi ne bi entia o nti me ye hihye foforo
okay
na media exchange de na me ne waye no say next month nti e bia me chiche mu say next month no me ma 50 na the following month mama 20 the next one mama 10 na ye de etie wie Inti sisi ano me exchange amount. Inti debt exchange program no. Eya baina omo ba beka che say sisi ano de kana me de no. Mintu ya at the time I make say metia no. Aji me chichemu. Inti chichemu no any exchange na ye ba be no. Na meka say na ye bo government ne bosia. So what a treasury bill da or government ne bosia. What a bond da is the same thing. Say a fund be cra mutual fund na waya. Mutual fund no sometimes yes she say nema akoyi ankofo mbisemu but say enkoyi a eno mbeba no mo abeka che say wa medi sika ma wo fund no mo wan kan che me say we na wo dey kwa akoyi but ye sika na ye the ma government biom we are lending to the government it obia was some kind of exposure to government government neighbor no or besre say yen sisa terms ne mano I be a bit favorable la or bit me di etiaka
eno ya born a tough no eno ano no I think your tree is pretty good. So we're asking what the debt exchange entails. Per the communication coming from the government, what exactly are the terms, these new terms that they are proposing that investors should sign on to?
Okay, so first off, this is Big Brother, which is IMF, doesn't come to you with conditions on what you should cut and what you should do. They typically will ask you to sit down and see what you can do and come to them and they arrange it with you. So what they require of us to be able to support us is to ensure that our debt stock is reduced to 55% of GDP.
Okay, currently where is this sitting?
We are currently doing a total debt stock of about 105% of GDP.
What that means is the value of all goods and services produced in the country for the year is less than the value of our debts.
Yes.
And the debts are more than it by 5%.
Yes.
And so we are debt unsustainable.
Yes. And whatever exchange program that we are supposed to do now is supposed to move us to 55% of GDP.
All the way from 105
yes.
to 55. So we want to cut it by 50%.
Yes, and that's not all. We have to do it within 5 years.
That's the plan that the government...
That is the requirement for the IMF to support us.
I see. And so so this debt exchange is intended to get shed off some of these debts. Is that part of the plan? Because if my debt to GDP is around 105%, how practically do I reduce that? Am I going to automatically increase my GDP so that the numerator becomes more?
So with this exchange that they are doing, the rate of the instruments you have bought or the securities you have bought are being reduced.
Oh, so the interest on it?
The interest is reducing.
Okay.
And it's spread over a longer period of time.
Okay.
Which means that month on month, assuming I have to pay month on month, the pressure on my income is not as much.
Okay. Okay. So my debt service obligation, we are trying to reduce it.
Yes.
Per every period.
Yes.
That is false due.
Yes.
And so they are spreading what probably should have been paid as a bunch into little bits over time.
Yes.
Okay. So in terms of the specific terms as communicated, coming back to that, what was it that the government had proposed?
So initially, and it's gone through a certain number of changes, like when we had a deadline for this program being last year 31st December to 16th and now to 31st January. Initially it was 4 bonds they were splitting it to, but now it's 12 different bonds.
Okay.
So whatever that you have will be split, and then the rates on it have also been reduced to between 9 to 10%.
Okay.
And there's a whole calculation that is a bit technical on what they will pay you every year.
Okay.
So these bonds spread all the way to 2038.
2038.
Yes.
So we are in 2023. So the next about 15 years.
Yes. And that is why you hear the pensioners crying about this.
Okay.
Because some say that I will not live that long. And yesterday, listening to one of the discussions that were going on, their point is really we have paid our due. We worked, we paid our taxes, and at the end of life, when we have saved some money, that should be taken care of. Because a lot of people depend on the coupons that come in to take care of themselves. And it's at that retirement stage that all these illnesses come in, and you have to pay for huge hospital bills. And some are even going into a state of shock just by this news. So yes, it entails a lot. It's huge on us. And
so let's have you explain to listeners, when you say coupon and viewers, when you say coupon, what exactly is the coupon?
Okay, so when you buy the bond, it's normally a bond that pays coupons.
Okay.
And the difference between a treasury bill and a bond is just the period.
Okay.
Treasury bills are normally short term and the bonds are long term.
By this arrangement. But before that, if you're watching us, if you're listening to us, please send through your comments, your questions on both our Facebook and YouTube pages. Or you can also drop us a message on our WhatsApp number 0501 579 996. 0501 579 996. Who are the people who get to be impacted by this debt exchange program?
Everyone. And I'll explain why.
Yeah.
So first off, individuals. Every individual that has an investment with an exposure to government securities, typically bonds. So I mentioned the individual bond holders.
Okay.
There are some people that buy directly the bond, and there are some that buy indirectly.
Okay.
And these indirect ones are the collective investments.
Okay.
So collective investments are such that they have mandate to invest in different securities. So you have a money market fund that invests in short term, like treasury bills, fixed deposits, etc.
Okay.
And then you have fixed income funds that invest in bonds, typically bonds. And so you can have government bonds, corporate bonds, etc. And then you have equity funds, for instance, that focus on equity. So anyone that has exposure to either directly by buying the bond from the government or indirectly through a fund is affected. And then institutions. Institutions, mainly the financial institutions. So if it's a bank, a microfinance, a savings and loans, they also typically buy government securities. And then insurance companies as well, they are also hugely impacted because when they take the premium, they invest it in some of these securities. So one way or the other, if you are not affected, maybe your parent or your sibling who gives you money at the end of the month for upkeep, etc., would also be affected, and consequently you would.
So indirectly, all of us get to be impacted.
All of us are impacted.
But we know there are certain people who are exempted, who still have some investment with the government. But we'll go for a quick break. When we are back, we'll let you provide us with further details on that. And also, let us know about what this whole haircut is about. What is in that haircut? You're still listening to Let's Talk About. You're watching us as well. It's Let's Talk About coming to you from Trinity United Church. And today we are talking about what is in a haircut. We're talking about the Domestic Debt Exchange Program. Don't go away. We'll be right back after this short break. With the growing challenges of life in light of both global and domestic development, the Christian is faced with the difficult task of balancing survival within a secular system and at the same time living a Christian life that pleases their Maker. It is for this reason that we need to have frank conversations on the many issues of life through the Christian lens. So, we bring to you Let's Talk About. On Let's Talk About, we talk about health, career, dating, marriage, family, divorce, politics, finance, and all the issues of life that the Christian is confronted with on a daily basis. Join us this and every Wednesday on the YouTube and Facebook pages of Trinity United Church Legon, and let's talk about life as Christians. With the growing challenges of life in light of both global and domestic development, the Christian is faced with the difficult task of balancing survival within a secular system and at the same time living a Christian life that pleases their Maker. It is for this reason that we need to have frank conversations on the many issues of life through the Christian lens. So, we bring to you Let's Talk About. On Let's Talk About, we talk about health, career, dating, marriage, family, divorce, politics, finance, and all the issues of life that the Christian is confronted with on a daily basis. Join us this and every Wednesday on the YouTube and Facebook pages of Trinity United Church Legon, and let's talk about life as Christians. You're still on Let's Talk About, coming to you live from the Trinity United Church. And today we are talking about what it is that is in a haircut. We are talking about the Domestic Debt Exchange Program, and today we have for our guests, our resource person, Madam Miriam Maku Emisa. She is a certified coach as well as an investment professional. She's been talking us through all kinds of things. So, just before we move on to the next question, I gave a precursor to it before we went on the break. The second part of conversations we've had, let me have done a tougher kakra with Chima Mayana. You better CP.
Never me homework. Okay. Okay. So, I'm saying, Ubisa say the effects are sad debt exchange programming and citizens and Ghanaians. So, and as the mechanic say, debt exchange affect you in the sense say first people be affected omo government and are buying bosia through various investments or instruments make investment instruments and now so what's a treasury bill that what's a bonds that but when the debt exchange they affected omo omo abobosia in line with bonds no especially and say what to bond no directly and as indirectly so ebi wo honoma one call directly to a buying say oko buying a buying bosia but what call to abia collective investment the friend mutual fund mostly in friend mutual fund what call toby and now why invest where no mubi emepi no ye jisika na ye de call to government securities ni bi inti ye wo omo ye exposed directly and now more indirectly no omo exposed
okay.
Now another group of people that affect you so financial institutions into banks savings and loans microfinance and kofu we nyina omo jiji sika no omo jiji sika na omo so omo dey investments na make say insurance companies so omo ji premium na funeral policy and also educational policy omo jiji sa sika ni mu nyina omo so omo dey koye investments and na for the longest time they be asema ye can say abind there eye den obetua inti risks ne wo form ti most of the financial institutions no omoji sika wo ye ho a omo so omo bo abind bosia inti obi a wa bobosia in line with bonds no ne ho kemu bi na make say ye nyina also because individual na ebia wabo aban bosia no ebia no ye wunua ebia no ye wo papa inti sika na akokemu no ososo de ode bema ono ebe affect wo inti ye nyina ye ho kemu bi ena debt exchange so there the intia individuals so ko ho ne say ana haircut na ubo din no interest nse na mekan ye no interest ne dawso inti exchange no ebekte interest na government was say tia oka no na de enkrofo kan ya calculate ahwe no between 77 to 80% of bosia wa bomo no eso better in terms of interest
enti sika na udi kind shame ne de omonte so eye principal no ne amofre ne principal no na interest no na unya ni nyina senior originally omone wo edi ano no
sana omo akire
okay
but ebi mu wo ho a ebetumi affect principal names
under the domestic debt exchange program
domestic exchange program ne there principal no anhwe ya enka no
okay
but in terms of value so almost spread no over that long time na nkofo bebre say na sika no asay
ania abrofo no friend time value of money
exactly
okay medi misika ma ene waka chere me say obetua no nyame ya adoma na woche sene na afi emma so na ese utua sika na say oh ene mean to by that time na metua no nkakra afi and make say oh and I say midwetire no wase no and no na more kind of time value of money say sika no will still be affected okay that's here so thank you very much there's a question coming through. I would like us to take a few of those questions and then we'll go back to our conversation. But if you're joining us on Facebook, on YouTube, today we are introducing something new. You can also join in and ask your question directly. We can see you, we can hear you. So there's a Google Meet link in there. You can just click on it and you can join into the show and you can ask or make your own direct contributions as well. So aside from your comments that you can leave, you can also come in by voice and also we can see you and we can take your questions and contributions. So there's a question coming through from Joseph Jemfi. He says, please, are we not on a debt peak to push for HIPIC than to sweep our unsustainable debt under the carpet for another loan from IMF, or both are the same? Joseph Jemfi, clearly, he understands some finance. Or say, baby, I do know, and yet, baby, just say, ye sika, yen katsem no, do a very unsustainable level that we should push to HIPIC. And HIPIC implication is, Obeka say, we are highly indebted and our also are poor. Ain't you know, omo awodi omo kano, omo fa wo kano, e be in chill. So don't we have that option to push for, instead of we pushing this under what he calls the carpet for another loan from IMF? And I say, me no nyina ya de krona.
Osha ye data. Ye poor country.
Yeah, poor country.
Expenditures are ye no sha ye poor.
Me. Osha ni na ye to turn. Okay.
That is just by the way, but I think we've gotten to that point. The IMF coming in is not just for the loan, but to have another eye to watch and keep the discipline in terms of how we are spending. And see, I think that, but in terms of even going to seek and ask our creditors to cancel some of our debts, I know that is also part of the plan.
Yeah.
Yes, it's part of the arrangement, but it's very necessary that we have that discipline in terms of our expenditure as well, because it's sad that even in the midst of this, we still have budget increases in some of the things that we are doing, and we still hear government officials preaching and making promises on things that they want to implement and do. So it is important that we have the discipline, and I think that is why the IMF approach is better.
And just a bit more of education, especially for Joseph and everybody else who is asking this. So for you to qualify for a HIPC arrangement, you see, it's not, you are not just highly indebted, but you have to also be poor. Per our GDP position right now, we are classified as a lower middle income country. So we are not a poor country. And you know, one element necessary for you to qualify for a HIPC arrangement, we don't have that. So we don't qualify as a poor country per their assessment, the global assessment, for one to qualify to be HIPC. But then again, we've already utilized that HIPC arrangement in the past. And so once again, it becomes difficult. But as Miriam was saying, there are certain arrangements to help us to get some debt forgiveness. And so you hear about the Paris Club, where there are multilateral investors, like some of these, you have the World Bank and all of these other institutions who typically lend to countries who are considering the possibility of forgiving some of our debt. So that's just by way of a bit of education. And Miriam, coming back to our conversation, and I want you to talk about the Ghana Association of Bankers, because you mentioned it, that they've been able to negotiate something better with the government. If you can give us a bit of the details and what this means, especially for anybody who has any funds with the banks or any investment with any of these fund management companies.
So first off, the fund managers are not part
of the Association of Bankers.
Okay. They are regulated by the Securities and Exchange Program. Commission. Programs not those. I think that the components of this is, and the highlight for me is the fact that in the first year, as compared to the previous arrangement where they were not going to get anything, at least they have some payments being made in the first year.
Okay.
And what is important is that in that first year, you are getting liquidity.
Okay.
And as they say, cash is king. You need cash to run your business. And once that is made available, once that cash is made available, it even opens up for other bonds to trade as well. And gradually, we may be able to see some activity on the secondary markets.
Okay.
What it means for you as an individual who deposits monies there as well, it is also to say that this will put them in a better position in terms of their financials, and make their business more sustainable. So it's a move in the right direction. It's progressive. That is how I would call it. And it's good news also because truth of the fact is that we need this thing to go through for the economy to pick up and build up. And the bankers or the banks form a greater percentage of this debt we're talking about. So once we get them on board, that is some progress that we have made.
And in respect of that, so what you are basically saying is, one, the benefit is there will be some liquidity in the initial year as against what the initial arrangement is.
0%.
Which was 0%. And the second thing is, it allows the banks to continually function and also meet their obligations as they fall due. So they will be able to continue in business. And so that is one good thing for the entire economy. Efo Abrahams is asking, what is happening with the individual bondholders?
So it's not clear yet what decision has been taken. So there's the IBF, which is the Individual Bondholders Forum. And I think they've been able to amass enough support from the individual bondholders to get the ear and attention of the government. So quite recently, there was a negotiation where they put across their submissions in terms of proposal in terms of what government should do, and their stand is that they should be exempted, given that the allocation of their debts in terms of the full pie is not that much, so they should be able to pay them. They haven't come to a conclusion yet. I'm sure they're still waiting for government to respond to that. And the collective investments have also joined that crusade. So we are yet to see what will happen. But I am hopeful that we would be able to reach better terms and get this moving as well. Okay,
so aside from the individual bondholders, so we had heard that pension funds were going to be exempted, but then a certain committee had been put together to work the terms of how that exemption is going to be. Have we heard anything subsequent to that initial announcement?
Not yet. That is also not clear. And speaking to some of my friends in the pension sector, I think most of them have taken the stand to act as if they are part of it rather than not, because it is not clear. So at this point, that is where we are. There's no clarity yet and conclusion yet on the pension funds as well.
So just by way of information for our viewers and also those listening, so she mentioned that the commercial banks, they constitute a significant percentage of this entire program. When you look at our investor or our public debt holdings by investor type, as of the end of September of 2022, commercial banks constituted 33%. And that is the single most significant category of investors who have their monies in government instruments. And so that just goes to buttress how important it is that the commercial banks are safeguarded by whichever means so that the financial sector does not come crashing. And so that is a very important point that Miriam put out there. Yawosu Safo asks, hi, Ghana is getting into the realms of barter trading, gold for oil, bauxite for cash. Assuming we had a good stock of gold at BOG, could we use our gold to solve this problem?
No.
We cannot use the gold to solve this problem?
I do not think so, and that is my personal opinion.
And what is informing this position?
I don't think we have enough gold. Yes.
But he's asking, assuming we had a good stock of gold at the BOG, could we use this to solve this problem?
Assuming. we had enough gold to sell, that would have made it, maybe probably given us a better position, because that is income, more income that is generated.
Yes.
So that could have put us in a better position than we are now. So that is assuming again.
that were the case.
Yeah.
Anyway, great. So now let's look at this. Businesses, individuals, and I'm talking, when I say business, both enterprises and incorporated entities as well as individuals are being affected by this. For us as individuals, enterprises, incorporated businesses, what should be the response to this situation? How are we to react? Are we to go and say we are taking our monies out from whichever instrument that we find ourselves in? Because you are saying this particular program must succeed for the economy to bounce back. What is supposed to be the response from the myriad of interested parties?
Okay. It depends on a number of factors for me. So if you are an individual bondholder, it is even very difficult at this point to be able to liquidate because there's not much cash going around to buy the bonds that people are holding currently. And if you are even willing to sell it off and someone is willing to buy, they will buy it at such a low price. That is why it is called a junk. So it will not make that much sense for me to sell it at this point and lose so much.
Okay.
It would be a good idea to just pause and see how the situation pans out to take that decision. Again, I think a number of people have also asked whether they should join the debt exchange program, especially for the individual bondholders, whether they should sign on to it or to hold their peace. My personal position is to wait and see what the negotiations will come up with, and then take an informed decision. Because if you sign on now, you probably will shoot yourself in the foot, because the terms will not favor you, and also because what you still hold, which is the bond you still hold, the government is still required to pay you.
And so it is wait and see to take an informed decision.
Exactly.
Don't rush into liquidating your instruments right now.
Yes.
Because you may have something very little for that.
Yes.
And that brings me to, the losing value brings me to the issue of mark to market. So there was a time we heard that a number of people who hold instruments with some of these fund managers, they were losing value on their instruments. And we were told it's because of a certain mark to market valuation of those instruments. What does this mean?
So for our collective investments, which is what the funds that the fund managers manage, typically in reporting these funds, we report the cost, which is the money you have brought, and then the interest that you would have gotten over the period based on the investments that we have made. Now, these funds for the longest time have been very liquid, in that there are always investors going into the fund and some who are exiting. And there was always enough to pay out those who were exiting with those who were coming in. And so typically when you buy a bond or you buy a treasury bill, for instance, you didn't have to go and trade it for liquidity. You simply had to hold it to maturity, and therefore reporting your accrued, your cost, which is your investment plus the interest over the period, was okay. But we got to last year, and then rates on the market started going very fast in terms of increase. And so people were going to buy that instead. So the number of investors joining the fund as compared to those existing had changed.
Okay.
So there was not enough liquidity. So you had to disinvest some of the instruments you were holding to be able to pay. Now, when you hold a bond, that is like 19% simply. And on the market the rate is now 35%. Anyone that is willing to buy off that 19% will buy it cheaper.
Yeah.
So the loss you make in disinvesting is what costs the fund.
Okay.
So the prices of the funds had dropped as compared to where they were if we assume that we were holding all the securities to maturity.
Okay. So you used costs and you also used price.
Okay.
So the prices have dropped.
That's the bond price.
The bond price, but the cost of disinvesting has gone up.
Yes.
And so for me, the manager of the fund, that someone has put their money in, it becomes more costly for me to get somebody off than it is for someone coming in. And so it doesn't make my instrument valuable. That's what you are seeing happen last year.
Yes.
And because of that, a number of people moved from these instruments. And so it made the value of these things drop.
So typically when the value drops because the bonds that we hold, okay, should we sell them, it will come at a loss
to you,
to the fund,
if you have to sell it
if you are to sell it now.
Yes.
So that's what I explained. If I'm holding a bond 19% and now on the market that same bond, a 2-year bond, will go for 35-40%, then if I have to sell it off for cash, anyone willing to buy it will buy it at a low price. Okay, so that drop in price is the loss you are making. And most of the valuation of the funds that we have on the market, we're assuming that we will hold all our securities to maturity. That doesn't necessitate any selling or disinvesting before maturity. Okay.
So before this phenomenon you're talking about happened, you were valuing these instruments with the assumption that they'll be held to maturity.
Exactly.
And so what that means is you can agree a definite rate of return for any investor.
Yes.
But because of the changes in the market, now you needed to peg the value of the instrument in alignment with what was happening in the market.
Yes.
So although you may have agreed, someone would have bought an instrument, say 10 cedis, knowing that at maturity, the person will be getting 15 cedis. Now, midway, you are telling the person that even your 10 cedis that you brought, the market interplay has brought the value down to 8 cedis. So not only are you not going to get 15, you are actually going to get less than your 10 because of the interplay of the market. And that's what the mark-to-market resulted in.
Yes.
So what this means is the market, once again, can interplay for you to even get more than the 15 that originally was negotiated.
Exactly.
And so that is now the kind of market we're operating in.
Yes.
I see. So someone is asking. I called my relationship manager of my bank to stop my treasury bills when it matures. To my amazement, I was informed that was not possible, as the government had directed them to automatically roll over all treasury bills. What does this mean? And this is coming from Kwame.
My dear Kwame, this is news to me because I know some of my clients who were paid maturities today.
Okay.
So for that kind of instruction, I would have to check whether maturities for treasury bills are not being paid, and an automatic rollover is being requested.
Okay.
But recently, we had that on the cocoa bills,
Exactly.
and it was reversed for the individuals. So I would have to find out that information on the treasury bills being asked for an automatic rollover. Yes.
And I'm very happy that you mentioned the cocoa bills, because this was communicated. We know the Bank of Ghana sent out communication to that effect, that they had issued certain bills on behalf of Cocoa Board, which are the monies they use for some of these, the trading of cocoa on the international market, and that these were instruments they only sell to some of these commercial banks, and they are not intended to go as retail to other investors. And so that arrangement is not supposed to impact retail investors. And so, as she was saying, there was a certain reversal which had been done around that. So, Kwame, we would advise that you call your relationship manager again to find out what the status is in respect of this. So, the conversation has gone very wide and broad. It's been very deep as well. What has become evident from our conversation is people are not very much excited when it comes to bonds, government instruments, when it comes to mutual funds, when it even comes to treasury bills, as concerns are being raised, although we know treasury bills are exempt from this arrangement. If somebody has money now and is not locked up in any of these investments, but the person is seeking to invest, what would you provide by way of advice, the kind of approach that anybody having some excess liquidity should use in seeking to earn some return for their disposable income?
Okay, so what I would suggest, so my dad, I always use him as an example. He had financial investments with collective investments like we do now. And unfortunately, during the cleanup, he lost everything.
The financial sector cleanup?
Yes.
In 2018?
Yes. And it happened in the asset management industry as well.
Okay.
And one of the companies he invested in, he lost the money. But he's doing well. He's 70 years old now. And what he's managing with currently is his rental income.
Okay.
Because aside the financial investment he made, he was also able to put up a 2-bedroom house and then renovate the one he's living in to have an extra room he could rent out. So what I would say now is that when these things happen, they should give us opportunities to think out of the box in terms of investment. If you're thinking of a business, every investment has risk.
Yeah.
So if you're thinking of an investment or you don't have that great idea, but someone approaches you with a great idea, you should be able to invest in it. That should also bring you some returns. If you think you have enough to buy a property that is well situated and can bring you some good rental income, it's also good enough. If you don't have that much, I also advise that you stay liquid in terms of short-term investments that are on the market, like a fixed deposit or some of the collective investments that purely invest in money markets, such as the fixed deposits that I'm talking about. But again, the risk lies with you. So make sure you're choosing something that you are comfortable with. Every investment comes with risk.
Some risk.
Yeah.
I'll come back to this, but we are fortunate to be joined by someone online on Google Meet to ask a question. Thank you very much for joining us this evening. Your name, where you're calling from, and your submission.
Hello, can you hear me? Hello, can you hear me?
Yes, yeah, we can hear you. Please go ahead.
Right. I wanted to ask a couple of questions. One, so considering how unreliable the Ghana government seems to be over the past few months or year, are there any foreign financial investments that we could look into putting our money in? That's my first question. And the second question, just for clarity's sake, um, are you saying that we should, at this point in time, it's too late to withdraw our funds from these investment instruments since we'll get a significant haircut? And if that's the case, how long should we wait before we can take our money out of these investments? I don't know if that's clear.
It's very clear, and we'll get Miriam. So, Miriam, he's basically asking, given all these challenges with instruments with the government, what are some of the other investment opportunities we can consider? And I think that's pretty much the question I asked before his call came through. And then the second part was just to get confirmation that, is it the case that it's too late for those who have monies in some of these investments to disinvest, given the significant losses they are likely to make? And if that is the case, for how long should they hold on?
So for the financial investments that I mentioned, for me, my personal opinion is to stay short in the short period, which is, and the options available really are the fixed deposits and the treasury bills.
Yes.
But again, it depends on the kind of risks you want to take. And as he mentioned, the government have gone up and down a bit on saying one thing and then coming back to withdraw. And so people are a bit wary of the treasury bill. But if that risk is comfortable with you, all I'm saying is that try to stay short in the short end of the curve, which is the fixed deposits and the treasury bills. And then on the how long you have to wait, I wish I could say how long you have to wait, but it's a good time to keep monitoring those funds. There are periods of times where the prices actually pick up. So, and it's very volatile and linked to information. Interestingly, it's become almost like our stocks. So I was just watching on Monday the losses on two of the funds that I monitor.
Okay.
The short-term fund was doing a loss of about 16%, and the
what
fixed
period, per annum?
No, the loss.
The loss.
If you should exit using the mark to market. So the price, based on the price, the loss was about 16%.
Okay.
By the next day, when information came that we were going to extend the deadline for the debt exchange, the losses had gone up to 25, which meant that if you had taken out the previous day, you were better off than the next day. Okay, and then after that, it started dropping again. 2 days later, I started picking up again. So there's so many things that affect it. So if you don't need the money now to do anything that will bring you a return, you can just be calm and monitor the markets. I'm sure these funds have relationship managers that will be very willing to give you the prices on a daily basis, because now that's why it's called the mark to market. The Ghana fixed income market gives us prices on a daily basis that we use to value the funds, and depending on what is happening on a particular day, you can have the losses getting better or sometimes being worse.
And I think we need to take what she says very seriously around the government treasury bills. So the government in its operations, the treasury bill is a source of short-term liquidity for the government. What that means is they cannot afford for people not to want to buy treasury bills. And so if there is anything they are likely to default on, that is one item that they will be very wary to default on. And so that, to an extent, minimizes the risk buying the government treasury bill, because they would want to be able to continually issue it because it provides them short-term funds. So for what that is worth, I think the treasury bills, relative to other government instruments, relatively safe. And talking about treasury bills and government instruments, a question is coming from George Koo, and he says, from our basic economics, our lecturers made us understand that the government bonds and treasury bills were the safest investments. And most of the time, they call it the risk-free investments. And so his question is, how come we have found ourselves in this situation? Did the textbooks lie? That's the question.
George, I'm asking the same question as well. Because I also read economics and the same story, in fact, until last year was what I preached. On every stage I stood on that the government's securities were risk-free. And before Ghana and all this happened, there have actually been countries who have defaulted, other country governments that have defaulted. So yes, sometimes we said it confidently, but we did put in a caveat.
Yes.
And if history is something to go by, but changes happen and then we learn new things and put it in place. So yes, what has gotten us here, I think that we have discussed it from the beginning, that we did some spending and we kept borrowing. Not that governments don't borrow. Most of the governments borrow. The US government borrows. And they borrow to finance their projects and expenditures. But it's always with the intention to refinance with more bonds or more borrowing. What hurts us is the fact that most of our borrowing was also not productive. So when we brought in these things, how did it affect our economy to grow, to make us more money? And I think that is where the crux of the issue is. Not that governments don't borrow. Governments do borrow to finance their projects, but what are we using the borrowing for? And to what point, and at what point do we end and say that, okay, this is hurting us, we need to put a stop to it and look at other things that generate income for us.
So the textbooks did not necessarily lie, just that, you see, that premise is based on a certain assumption that governments will not go anywhere. A government is in continuum. So a particular political party would constitute a government, they will go, another will come. They inherit everything, all the assets and liabilities. So government will be in a continuum. So the government doesn't go anywhere. So you are likely to get your returns. But what we have found ourselves in, as she rightly said, is, were we at a place where whatever we're borrowing the monies for, it was earning us something? And that's what she says, whether our borrowings were productive, talking about the things we use them for. And unfortunately, per the records, a lot of them were not that productive, and so we find ourselves in this place. If Abrahams comes through and asks again, what is your advice about investment or investing going forward? Should we stop investing in treasury bills, fixed income, insurance packages, etc.? Because these will indirectly end up in bonds.
So what I say again is, when all of these started, we had quite a number of people canceling their standing orders for products like these. And what I say is that you can't stop investing, because you will grow and retirement will come, and so you will still need money for future expenditure. So yes, like she rightly asked, so then what is the way forward? I think you should still invest, but just consider the risks that you are able to take. For some people, they bought bonds and they had to sell off these bonds at a point. They made losses, but hey, they understood the risks they were going into. So with the risks that the loss they made, they still appreciated what was going on. So for you, what kind of risks can you take? There are still equities out there. There are still fixed deposits out there. that she can invest in that don't go under the debt exchange program. And also don't go under mark to market. So if these things are comfortable with you, please don't stop investing. Do something that will generate income for your investment. Don't eat your seed.
Great. Don't eat your seed. And this brings us to rounding up the conversation. And next week, we'll be bringing you the part 2 of this conversation. So now, we are going to be looking more at what the implications are and what the responses should be in a much further detail. And so we'll be talking about that. But just to close us off, a question that just popped up in my mind. You know, a number of families, especially a couple who do some of these investments, they will typically pull their funds and put them in some of these passive investment instruments. Now that we find ourselves in this situation, what should be the approach? Should they be considering probably splitting and putting their monies in different instruments to diversify their risk, the portfolio, and also for someone who is, say, within their earning years, from 30 to about 40, 45, compared to someone who is around above 50 towards 60, and those are on pension? What should be the approach towards this entire domestic exchange program and investments going forward?
So on the first part, I don't think this is an excuse for couples to say that we won't put our monies together. There's strength in unity, so please still put it together. The diversification comes in what you're putting the money in. So I can bring 50 and you bring 50, we have 100, and then we decide to split the 100 into maybe 50 into treasury bills, 50 into fixed deposits. So that's where you have the diversification. So it's still okay for couples to put monies together and invest. And then the second part, in terms of what kind of investment you should be looking at in terms of your age. The younger you are, the more time you have. And so, and what time gives you is the ability to recover from mistakes and errors like these. What the older person or the one nearing retirement doesn't have is time. And so they don't have time to make these mistakes, and they don't have the time to recover from them. So if you would advise one getting closer to retirement, they should keep their funds in liquid instruments or near cash instruments like the fixed deposits, or sometimes overnight rates or call accounts that the banks have. And then the younger people can look at the equities and stocks and bonds market and the other fanciful things that the market,
like real estate,
businesses,
like
etc.,
farming and all of
farming, etc., productive things that still are quite lucrative. Yes.
Thank you so much, Miriam. It's been such a difficult yet enthralling conversation, and we are trusting that you watching us, listening to us, you've learned a lot. As we did indicate, the conversation goes on, and God willing, next week we'll be looking at what the implications are, especially for individuals, and how we should be responding to this debt recovery program that our government is leading us with. We've been talking to Miriam Maku Emisa, who is an investment professional and also a certified coach. This has been our episode on what is in a haircut on Let's Talk About. My name is Benjamin Ofeado, and on behalf of the entire production team, we thank you for joining us. Do have yourself a good evening, and let's meet same time next week.